All right, we are going to look at the last part of the case study in this video, which is using the money. So in the last video, we looked at how to maximize the cash value. We looked at a number of different options with MassMutual, Guardian, looked at the guarantees, the product design, studying illustrations. I had a ton of fun, to be frank. I always love talking about this stuff. But in this video, we're going to look at leveraging the policy. Now, when it comes to taking policy loans, specifically this individual was interested in what? Well, he wanted to leverage policy loans. We talked about direct policy loans, but then also cash value collateral loans, which are much more attractive to him. One, because I will see a lower cost to borrow. That is what he is interested in. And then number two, he's going to use these loans for his real estate business. So when I take out a policy loan, if on the paperwork, I check off a box, or the box, that states that this loan is for business purposes, not personal, that generates a potential tax deduction. It's much easier to deduct the loan interest on a business loan with a bank compared to a direct policy loan. If you're taking loans from your life insurance policy, if you're borrowing against the policy directly, the IRS generally does not allow loan interest to be deducted. Now you can do it. I've seen CPAs do it. That's why I say you can, as long as everything's properly documented, agreements are in place. However, it is something that the IRS, in my opinion, may look at more closely. And just if I want to stay clear of them, this does make life a bit easier with respect to that. Deducting the loan interest and getting a lower loan interest rate, we can often find 3% here. So what we're going to look at is a couple of different models with Mass and Guardian, different models of max funding the policy and then leveraging a cash value collateral loan, which we have a workbook. If you work with us, reach out to us anytime. We can provide this workbook to you. If you're working with us on a policy right now, we can send it as well. But he asked a really, really good question, which was when analyzing the policy, particularly the break-even point, should we account for the loan interest? Because the loan interest, the payments he makes are technically out of pocket. So he wants to look at his overall break even, accounting for premium, PUA, and loan interest payments. And that's perfectly fine to look at, in my opinion. It's really up to the individual. Yes, you can argue, hey, if you're deducting that, you don't want to look at the whole amount, but it doesn't matter what I think. And what I mean when I say that is whatever you are looking at when studying the numbers, yes, there's certain things you could argue we should look at, but whatever you're looking at, if you want to account for the loan interest in the break-even study, let's account for that. I actually like that quite a bit. So what we've got here is a cash value collateral loan workbook. This example is the MassMutual 10-pay policy we had looked at before. So in the Mass comparison, from our last video, there's the 10-pay product. We'll start off with this guy. So as we look at this, what do we notice? There's the $250 for 4 years. If I don't touch it, there's my break-even point. Between years 4 and 5. By year 4, they've paid in a total of $1 million, and they have just about $1 million, $996,000 in cash value. Why? That $4,000 less does result in this average internal rate of return still being in the red in year 4 because I have less money than what I paid in. The annual IRR is positive 2.35%, and what that represents is years 3 to 4, I paid in $250, I got my $250 back plus another 2.35% on top of it. So that's the annual growth I saw in cash value. So we did not include the average internal rate of return of death benefit in this workbook, but we did cover that in the last video. So when leveraging cash value collateral loans, let's take a look at this. Most lenders will offer 95% of whatever your cash value is that can be obtained through a cash value collateral loan. A line of credit basically is what it is. You assign your cash value as collateral to the lender, they place a collateral assignment on it, and then you have a line of credit with them. Whenever you pay premiums or pump money into PUAs and increase that cash value, you can apply for an increase in the line of credit. Some banks limit that to 2 increases per year. Some banks don't, depends who you're working with. So what we ran here is 95% of cash value in a total line. Some banks offer 100, but most cap it at 95%. So 95% of $222, almost $223,000 is $211,000. So what that means is if this is the policy he goes with, and in the first year he's got just about 223, the maximum line of credit he can attain is just about $200,000. As he pays in the next year, there's his cash value, 463. There's how much he can draw against his line. If we look at year 5, where he's positive here, he's got $1,037,000, maximum line, about $985. So let's look at some scenarios here, shall we? Let's assume that we've got that $500,000 loan coming out in year 3. So what this will always assume here is as follows. There's my loan. There's my loan balance. Annual interest due, 3%. So we plug in the interest rate. We can adjust that because these rates will likely adjust over time if interest rates go up. Some lenders offer a 2.75% rate if I've got a 7-figure balance, $1 million or more in cash value. Most are right around 3%, some are 3.5%. But at 3%, there we go, $15,000 payment. I will be required to make at least interest-only payments each year with a cash value collateral loan, whereas with a direct policy loan, I would not be required to do so. I've got a bit more control there. I would have to pay the interest only if I drew everything against the cash value and I wasn't paying premium, anything like that. In this case, I have to. So this assumes interest-only payments. To the far right, what do I got here? Net interest. I should have called that net out of pocket. This will reflect the total interest payments I've paid cumulatively. So next, let's take a look at paying this back, shall we? So let's assume the first year I pay nothing back in principal and I begin paying back $100K per year, just for simplicity. Doesn't have to be that. We can pay it back however we want. But $500,000 in loan principal, we pay that back at $100K per year. Your true payments were technically higher than that. The reason why, when I say true payments, true out of pocket is the terminology or verbiage I should use, because with this, I'm paying the $100,000 plus the loan interest, 3% of $400,000 is $12K. So technically, I've paid that year $112,000. Going back to his question, which was, I'd like to account for the loan interest or the loan interest payments with my break-even point. Nothing wrong with that at all. So by year, let's do this, 6, now let's look at year 7 here. Year 7, what do I have? So I've got a little bit of loan balance left, but that's okay. My cash value is $1,127,000. But when he says account for the loan interest, what he's looking at here is to say, okay, I've paid in a total of $45,000. I've paid a total of $45,000 in interest. So how I'm looking at this is my true net out of pocket is $1,045,000, not $1 million. So his break even would still be about the same. If you look at year 5, cash value is $1,037,000. Interest payments, $36,000. So specifically what he's looking at here, do it this way. That's better. Board is cool, right? Especially when it doesn't work. So I'm going to do it this way. If we look at year 5, total interest payments with this loan is $36,000. He's paid in premium and PUA payments $1 million. So he's saying, I've paid in premium and PUA $1 million plus $36,000 in interest. Therefore, my total out of pocket is $1,036,000. Forget about the tax deductions with the whole business loan right now. That's my out of pocket. My cash value is $1,037,000. So that's how I like to view my break even in this particular point. Okay, provide transparency with the numbers. It's just awareness more than anything else. So let's look at some different products here, different funding options, because this is the kind of stuff people like to see, especially if they're viewing this as a large personal line of credit that they can use whenever they want for real estate, as an example. Let's take a look here and plug in a different option. Shall we plug in the Guardian option? Let's be creative and plug in the option. We're paid into it for a long period of time. So we've got the total payments here. Now we've got to update our cash value in the IRR first. Cash value. Let's go all the way down. Very important. Annual IRR will automatically update. The average IRR will not, because we pull that directly from the software. The insurance company's software. Be completely transparent there. There we go. So, first year CV, or loan to value, I should say, a little bit lower because the first year cash value with the Guardian product is a little bit lower. Now, can we draw still in year 3 $500,000? Yes, there's not much of a difference there. However, when we look at the same example, here's what he might look at. I would look at this to say, all right, year 5, I have paid in $1,050,000 in premium and PUA payments. My cash value is $1,065,000. So if I don't touch it, there's my break-even point. However, if I'm going to look at this loan scenario, I take out the $500,000. Let's assume, Steve, I'm paying it back in the exact same frequency. There's the loan interest out of pocket. There's the loan principal payments. But I am going to count these loan interest payments toward my break-even point. By year 5, I've paid out of pocket $36,000 in loan interest, which if I add that $36,000 to my out of pocket here, what does that give me? $1,086,000, where my cash value is $1,065,000. So it's important to look at that stuff. That means he's going to view that as, hey, the true break even here is really not year 5, at least not the way I'm looking at it. Yes, it is on premium and PUA relative to cash value, but when I factor in loans, no. So people like to look at this kind of stuff. We want to make sure that we highlight it for them. So when would the true break even point be? If we look at year 6, 1.1 million in total payments, plus another $42,000 in interest payments. There we go. So $1,142,000, cash value $1,159,000 based on the present dividend interest rate. Present dividend interest rate. That will fluctuate over time. We can plug in the guarantees and such, but it's interesting and it's very beneficial to look at this as well. We can plug in $1 million or million different loan scenarios as well. So hopefully you enjoyed this one. I love going through this stuff. I hope you do as well. If you'd like to see personalized scenarios, please feel free to reach out anytime. If you enjoyed the video, please hit the like button, subscribe for more, and as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.